America believes it has seen this movie before: a rising rival, trade disputes, currency tension, political posturing. The assumption feels reassuringly simple. China is bluffing, markets will adapt, the system will hold. But history does not punish ignorance immediately. It waits, and then it removes wealth with precision. Over the last 24 months, China has quietly repositioned more than $8 trillion across reserves, trade settlements, supply chains, strategic commodities, and foreign assets. Unannounced, undebated, unexplained. This was not a market reaction, it was a decision. And its consequences will not arrive as a sudden crash, but as irreversibility. This documentary is not about predicting collapse. It is about recognizing the patterns that always precede it. Most Americans believe the loss of economic power looks dramatic: stock tickers flashing red, emergency press conferences, banks failing overnight. That is not how empires actually lose dominance. They lose it quietly, through accounting decisions, trade settlement changes, supply chain leverage, and reserve diversification. By the time headlines appear, the outcome is already locked in. This is why the most dangerous economic events are misunderstood while they are happening. The core misconception in America is the belief that economic interdependence prevents conflict. It never has. Interdependence does not eliminate conflict. It changes the battlefield, replacing bombs with balance sheets, missiles with payment systems, and troops with leverage. China understands this. America does not. The question most often asked by analysts: would China really damage the global economy when it would hurt them to? Misunderstand how economic power works. Economic conflict is not about avoiding damage. It is about deciding who absorbs it. Rising powers prepare alternatives. Dominant powers assume continuity. When separation occurs, one side experiences disruption while the other gains leverage. History is unambiguous. Across centuries and civilizations, every peaceful transfer of economic dominance follows the same structural sequence: dependency creation, leverage accumulation, silent repositioning, and controlled disruption. No ideology, culture, or politics overrides this structure, and no recorded case has ever skipped a stage. The first stage feels comfortable. Trade expands, costs fall, profits rise, consumers benefit, and politicians declare victory. Economics calls this efficiency. History calls it exposure. The rising power builds production capability, while the dominant power deepens consumption. Both appear richer, but only one grows stronger. In the second stage, leverage quietly accumulates. The rising power deepens trade while stockpiling reserves, strategic materials, manufacturing control, and routing power. The dominant power accumulates debt, complexity, and dependence. Markets remain calm, and calm is mistaken for safety. The third stage, where China now stands, is silent repositioning. Trade continues, diplomacy remains polite, markets function. Yet assets are reallocated, dependencies mapped, alternatives activated, and exit timelines set. This phase is never announced because leverage depends on invisibility. It is the most dangerous stage precisely because it looks normal. The final stage is controlled disruption, not chaos by accident, but instability by design. The system is not destroyed. It is selectively destabilized, just enough to force policy concessions, trigger capital flight, redefine settlement norms, and accelerate adoption of alternatives. Retaliation becomes self-harm. That is how empires lose dominance without losing wars. America missed the signals because it watches the wrong indicators: stock indices, GDP growth, employment numbers. China watches settlement currencies, reserve composition, commodity stockpiles, infrastructure ownership, and supply chain choke points. America believes power is expressed through markets. China understands power is expressed through options. When we say China moved $8 trillion, we are not describing a single transaction, but a coordinated structural shift across reserves, trade settlement, external investment, supply chains, and strategic commodities. Each move alone looks rational. Together, they form a separation strategy. Treasury exposure is reduced slowly to signal control, not panic, while gold accumulation accelerates quietly as monetary insurance. Trade focus shifts from volume to denomination, because every settlement outside the dollar weakens America's structural advantage by arithmetic, not theory. State-owned enterprises exit Western exposure on fixed timelines, signaling anticipated disruption rather than market sentiment. Supply chains are not cut, they are slowed, creating volatility, inflation, and political pressure that tariffs cannot counter. Energy, food, and metals are stockpiled not as inflation hedges, but as resilience assets, useful only if disruption is expected. This matters to Americans now because economic power shifts do not announce themselves at the moment of consequence. They announce themselves years earlier, when response is still possible. The United States still has options, but only if it recognizes the phase it is in. Denial is not neutrality. Delay is not strategy. And markets do not care about belief.
America believes power is loud. Aircraft carriers cutting through oceans, breakthrough tech pouring out of Silicon Valley, record-breaking stock markets, and soaring valuations that dominate headlines. These symbols matter, but they are not where economic dominance is ultimately decided. Real economic power operates quietly, moving through systems most people never see. Over time, the United States has developed a dangerous blind spot toward those systems, and that blind spot explains why China's $8 trillion repositioning has passed largely unnoticed by the American public, despite being one of the most consequential financial shifts of the modern era. The irony is that America once understood this better than anyone. After World War II, the United States did not become dominant simply by defeating its rivals. It became dominant by designing the system itself. Bretton Woods, the IMF, the World Bank, and the dollar's role as the reserve currency were not accidents of history. They were deliberate architecture. America didn't just win the war. It wrote the rules of peace, and for decades those rules worked extraordinarily well. But success bred complacency. Over time, dominance came to be seen as permanent rather than conditional, structural rather than strategic. The assumption took hold that no rival could challenge the system without direct confrontation. That assumption is wrong. At the core of this misunderstanding is a fundamental difference in how power is perceived. America believes power is owned, something secured once and defended indefinitely. China understands power as borrowed, temporary, conditional, and always reclaimable. The United States assumes the dollar will always dominate, capital will always flow inward, supply chains will always adapt, and allies will always align. China assumes none of these things. That single divergence in assumptions explains almost every strategic mismatch now unfolding. American economic analysis remains overwhelmingly market-centric. It watches equity prices, GDP growth, and unemployment figures, mistaking these visible metrics for signals of strength. But these are lagging indicators. China focuses instead on leading indicators: settlement currency share, commodity import security, industrial choke points, reserve vulnerability, and external asset exposure. One side watches symptoms, the other watches structure. By the time symptoms appear in markets, the underlying structure has already shifted. This is why apparent stability is so misleading. Markets can remain calm right up until they break, and history shows that the most dangerous periods are often those that look the most normal. In 1913, global trade was thriving. In 1928, markets were euphoric. In 2006, risk models insisted housing was safe. Stability is not safety. It is often a sign that risk is being mispriced. China's repositioning does not require a market crash to succeed. It only requires time. Crucially, China does not need to win in the way Americans instinctively define victory. It does not need to replace the United States as a singular global hegemon. It only needs to reduce U.S. leverage, increase U.S. vulnerability, create alternatives others can use, and force America into defensive policy positions. Power is relative. If America loses options faster than China does, China gains power, even if it absorbs costs along the way. This is why arguments that China would hurt itself too miss the point entirely. Pain symmetry does not exist in asymmetric systems. The same misunderstanding underpins the American myth of the dollar. Americans are taught that the dollar's dominance is inevitable because everyone uses it, holds it, and trusts it. But reserve currencies do not survive on habit alone. They survive on confidence and restraint. When a currency becomes overissued, politically weaponized, backed by rising debt, and dependent on external creditors, confidence erodes. Not suddenly, but cumulatively. China is not trying to destroy the dollar overnight. It is trying to make alternatives viable. That alone is sufficient. Sanctions accelerate this process. From an American perspective, sanctions are tools of power. From the rest of the world's perspective, they are warnings. Every frozen reserve sends a message: this could happen to you. Every swift cutoff increases demand for alternatives. China does not need to persuade countries to abandon the dollar. America does that itself each time it weaponizes it. China simply provides the exit ramp. Silence is central to this strategy. China has not announced what it is doing because announcements invite countermeasures. Silence preserves leverage. Many Americans assume that a lack of rhetoric signals a lack of threat, but history shows the opposite. The most damaging economic moves are often discovered only after they are complete. This is why 2026 matters, not as prophecy, but as timetable. State-directed divestment has deadlines. Infrastructure projects reach maturity. Settlement systems scale gradually, then suddenly. Preparation does not last forever. 2026 is when preparation ends, not necessarily when disruption begins, but when disruption becomes an option. And power, ultimately, is defined by options. The real question Americans should be asking is not whether China will collapse the global economy, but whether the United States will be able to respond effectively when leverage shifts. That question has an uncomfortable answer. Response time matters. Debt matters. Dependency matters. And all three are moving in the wrong direction. For an American audience, this is difficult to accept, not because it is false, but because it challenges identity. America does not see itself as vulnerable. Yet vulnerability does not require weakness. It only requires exposure. And exposure is exactly what decades of efficiency-driven globalization quietly created.
Economic warfare doesn't announce itself as war. There are no sirens, no emergency broadcasts, no surrender documents. Instead, it shows up as inflation that refuses to fade, shortages that feel illogical, and interest rates that keep rising even as growth slows. The experience is intentionally confusing because when people cannot identify the source of pressure, they blame everything except the structure creating it. That confusion is not a side effect of economic conflict. It is the mechanism. The most important truth Americans rarely hear is that China does not need to shut factories, cut exports, or provoke open confrontation to exert pressure. It only needs to recalibrate friction. Modern supply chains are so finely optimized that even minor disruptions cascade into major consequences. A one-week delay in a critical component can turn into a month-long production halt, which becomes higher prices, missed earnings, and eventually layoffs. This is leverage, not sabotage, and it is far more effective because it operates within the rules of normal commerce. Supply chains are the perfect weapon precisely because they were never designed to be resilient. They assume political stability, predictable logistics, and cooperative trade relationships. China controls critical processing stages, specialized manufacturing nodes, rare earth refinement, pharmaceutical precursors, and key inputs for batteries and solar technology. Control does not require monopoly, it requires irreplaceability. And rebuilding irreplaceable capacity is measured in years, not quarters. By the time alternatives exist, the strategic moment has often passed. This is why the idea of decoupling is so misleading. To many Americans, decoupling sounds like progress, proof that dependence is being reduced. In practice, most decoupling is cosmetic. Assembly moves, branding changes, final packaging relocates. But upstream dependencies, the most expensive, specialized, and politically sensitive stages, remain concentrated where they always were. The dependency still exists. It is simply harder to see. That false sense of security is itself a vulnerability. Inflation becomes the weapon of choice because it accomplishes what sanctions cannot. It transfers costs downward. Corporations pass higher input costs to consumers. Governments finance deficits through borrowing. Central banks are forced into impossible trade-offs. Inflation reduces real wages, erodes savings, destabilizes politics, and induces policy mistakes, all without a clear enemy to blame. No one feels invaded. They just feel poorer. This creates a trap for the Federal Reserve. When inflation is driven by supply constraints rather than demand, the Fed has only bad options. Raising rates risks recession, higher debt servicing costs, and stress in housing and credit markets. Lowering rates fuels inflation, weakens the currency, and erodes confidence. This is not incompetence, it is structural constraint. China understands this dynamic, which is why pressure is applied outside the reach of monetary policy. Economic stress then translates automatically into political outcomes. It does not require elections or negotiations. As inflation rises, voters turn against incumbents. Governments prioritize short-term stability over long-term strategy, and planning collapses into crisis management. Economic warfare achieves political results without treaties or declarations, just sustained pressure. And the people who pay first are not billionaires or institutions. They are ordinary Americans. Rent rises before wages. Food prices spike before policy adjusts. Credit tightens before relief appears. The pain arrives gradually, then suddenly. By the time it becomes undeniable, the transfer has already occurred. Markets do not crash first because crashes are inefficient. They are dramatic and they provoke responses. What matters more is confidence erosion, capital hesitating, businesses delaying expansion, hiring slowing, productivity stagnating. This is how economies weaken without collapsing. China does not seek chaos, it seeks compliance. Perhaps the greatest advantage China holds is not financial at all. It is patience. Democratic systems struggle with long timelines, diffuse responsibility, and voter fatigue. Authoritarian systems excel at strategic continuity, long-term planning, and absorbing costs over time. That asymmetry often matters more than headline GDP figures. This is why so much of this feels familiar to Americans already. Wages no longer stretch. Prices feel disconnected from reality. Claims of a strong economy don't match lived experience. That disconnect is not accidental. It is what systemic pressure feels like before people can clearly name its source. Americans are taught to believe that economic stress pulls allies closer, that shared values guarantee alignment, treaties ensure cooperation, and crises reinforce loyalty. History suggests the opposite. Under pressure, nations do not act on values, they act on constraints. And constraints rewrite alliances far faster than ideology ever can. All alliances are conditional because they are built on overlapping interests, not trust, friendship, or shared history. When interests diverge, alliances weaken, quietly at first, then decisively. Economic stress accelerates this process. Inflation forces governments to focus inward. Energy shortages demand compromise. Currency instability reshapes foreign policy priorities. This is not betrayal. It is survival. Europe offers a clear precedent and a warning America should not ignore. For decades, Europe believed energy interdependence guaranteed stability. Cheap Russian gas made industry competitive and conflict unthinkable. When pressure arrived, Europe did not respond strategically, it responded defensively. Policies became reactive, unity fractured, and the economic damage was absorbed domestically. The uncomfortable lesson is simple. Allies under stress prioritize internal stability over external commitments. There is no reason to assume America would be treated differently under similar conditions. China understands this dynamic better than the United States because it does not rely on loyalty. It relies on incentives and options. Through trade, infrastructure, financing, and alternative settlement systems, China offers something America increasingly struggles to provide: choice. When pressure increases, countries do not ask who they trust. They ask who offers the least pain. That is how alignment shifts without speeches, votes, or announcements. Capital behaves the same way. It is never patriotic, it is pragmatic. Before markets fall, capital moves. Before headlines appear, money exits. Before governments react, portfolios adjust. This silent migration is already underway. Central banks are increasing gold allocations. Sovereign funds are reducing dollar concentration. Long-duration U.S. assets are quietly avoided. Private capital seeks jurisdictional flexibility. None of this causes panic, and that is precisely the point. American markets often misread this as confidence. Inflows are interpreted as trust, but not all inflows represent commitment. Some are temporary parking, some are yield-seeking rather than belief-driven, and some are simply waiting for exits. When confidence truly shifts, Liquidity evaporates faster than models assume. Markets do not warn, they gap. Economic pressure also fractures economies unevenly. Certain sectors break first, not because they are weak, but because they are exposed. Historically, the pattern is consistent. Interest rate sensitive assets, highly leveraged industries, supply chain dependent manufacturers, consumer discretionary sectors, and real estate reliant on external capital. By the time broad indices reflect stress, internal damage is already extensive. This is why strong corporate earnings can be misleading. Earnings are backward looking, reflecting conditions that no longer exist. Supply chain costs lag reality. Currency effects lag reality. Demand erosion lags reality. This creates a dangerous window where markets appear healthy while their foundations weaken. That window is where most investors remain exposed for too long. Denial plays a central role in financial loss. It is not ignorance, but emotional self protection. Acknowledging structural risk forces people to reassess life plans, question institutions, and accept uncertainty. Markets reward optimism until they punish denial. This is why the largest losses typically occur after warnings are visible, not before them. The United States still possesses real advantages: innovation, deep capital markets, and unmatched military power. But none of these automatically resolve supply dependency, fiscal imbalance, or reliance on external creditors. Power does not vanish overnight. It erodes, and erosion is hardest to see from the inside. For Americans, this moment feels personal because the system has worked for so long that stability became part of identity. But economic reality does not preserve identity. It responds to structure, and that structure is shifting,